Markets peak when inflation is low and profit margins are high. It's not about growth. They like GDP to be very stable. They hate it bouncing around. It makes portfolio managers nervous. And our model that goes back to 1925 explains almost all the ebbing and flowing of bull markets and bear markets. And until June of last year. Starting in June of last year is the first time that inflation, the #1 predictor since 1925, is ignored. If you want to explain today's market level, yes, you have handsome profit margins. Every bull market has a wonderful economy. Every bull market has a plentiful supply of liquidity. But every bull market before this one had low inflation. In order to explain today's market, you have to assume 100% ignoring of the rising inflation, which is quite remarkable. Yeah, We've never seen anything like this. We've just hit 6% today. That would have been enough in any market since 1925. And for all I know, long before that, it would have been enough to have crashed the market. But this time, the faith in the Fed is so complete that when they say it's temporary, we believe it. The Fed, in my opinion, hasn't done a thing right since Paul Volcker, who was brilliant. All of the others have encouraged a chain series of really dangerous asset bubbles. They rattle the economy. They're incredibly disruptive. The decline in 2000, 82% in the NASDAQ was the decline from 2000. The decline of the housing market, all the way back to trend and below, dragging the world with it, and all of the problems from bad mortgages and a 50% decline in the S&P. These have a terrible wealth effect. They make people feel poor, and they make people spend less. Typical precursor of a bubble breaking. If you're looking for the very early warning signs of a bubble breaking, you find the stocks that have done the best, SPACs and particular SPACs and Tesla and Bitcoin. And you wait until they start to have these big daily drops, and then they recover and they drop and they recover. And that's the very early warning. And the market in 2000, for example, didn't go together. They took out the pet.coms and shot them. The rest of the market continued to go up. It didn't even deign to notice the shooting of those little guys. They were only worth scores of millions or a couple of $100 million. Then they took out the junior growth stocks and shot them, and the market kept going up. And then they took the medium growth stocks and shot them. And finally, by the summer, they were shooting the Ciscos. And the entire tech part of the market had been shot. And that had been 30% at the market peak of the total market cap. And yet, the S&P by September was at the co-equal high of March, which meant that the other 70 had continued to rise. So that is a typical way. Bubbles don't necessarily break en masse, but having sliced off the tech and the dot-coms, then finally the 70%, like a giant iceberg, rolled over en masse, the 70%, and went down for 2.5 years.